Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. With Kamala Harris and Donald Trump neck and neck in the race to be the next US president, it's a pivotal moment for investors. The outcome of this election could have significant implications, not just for US equities, but for markets across the world. So far, we've seen the S&P 500 rally by an impressive 21% year to date, which has until recently been dominated by a small number of stocks in the Magnificent Seven, but it's now broadening out to small and mid-cap sectors. Investment trusts in the North America sector have delivered strong performance, 29% share price total return over 1 year, 132% over 5 years, and 230% over 10 years. Yet, surprisingly, they're still sitting on an average double-digit discount of 21%. So what might the US election mean for investors, and can the rally of the world's largest economy continue? Today, I'm delighted to be joined by three managers from the North America and North American smaller company sectors. I've got Gary Robinson, who's investment manager of Baillie, Gifford US Growth Trust. Sven Anders, who's the US Equity Investment Specialist at JPMorgan US Smaller Companies Investment Trust. And Dean Orrico, who's the Portfolio Manager of Middlefield Canadian Income. Right, on to the questions. Where do you see the biggest opportunities in the US? I'm going to kick off with Gary.
Well, the first thing I want to say on this question, Annabelle, is that I think that the US remains the most exciting market in the world for growth investors. You look at the sort of previous waves of innovation that we've been through in the global economy with the internet and mobile, and it was US companies that were leading the charge with those innovation waves. We're going through another of those innovation waves right now with the emergence of AI and more specifically generative AI. And it's the US companies that are really at the vanguard of this shift again, which I think just highlights this point that America remains the world's innovation cluster. And these are the types of businesses that we're looking for, the companies that are innovating and which have got the potential to grow faster for longer. In terms of where we're finding opportunities, it's very stock specific across a number of different sectors. Companies like Shopify in e-commerce, Duolingo in education, DoorDash in food delivery, Meta in social media and advertising. What these companies have in common is, first of all, they're bringing new technologies to existing industries and reshaping those industries. And secondly, these are founder-led businesses which are more adaptable than average and more long-term than average. And that's one of the things that we're excited about.
Excellent, Gary. So US is leader of innovation. Sven, obviously you're looking at US smaller companies. Where do you think the opportunities lie?
Yeah, I think in general, where we do find the opportunities is in the small cap and the large cap space. I mean, if I think about one word, then that word has to be active. I think if the last 2 years really showed one thing, is that investors wanted to be in the active space. If you just strip out the Magnificent Seven last year in the S&P 500, the rest of the market was up only 8%. So there was a clear indication that you wanted to be in the active space. And that's even more true in the small cap market. We have a very broad market when it comes to number of stocks, close to 2,000 names in the Russell 2000 index. And there are some areas that are really attractive and some that are not. We do focus on industrial companies at the moment, but we also like some of the basic materials. We like some of the financials, even though last year everything was around the regional banking crisis that we had in the US. So I think this year in particular and going into next year is really one market for active management. And we do find opportunities across the different sectors that we have in the small cap space.
Great, Sven. So you're seeing opportunities across various sectors. How about you, Dean? Where do you see opportunities?
Well, as distinct from the other two, we're a uniquely Canadian focused fund. We have the ability to go into the US, and from time to time, we have been over 30% in the US market. But today, as we sit here, based on a number of factors, which I'll highlight, we're over 90% concentrated in Canada. We have a high conviction portfolio of about 35 names focused on financials, because we think the Canadian financials market is amongst the strongest in the world. We have energy and energy infrastructure, which I think has now come squarely back into focus. And then we've got real estate. And that represents together in aggregate about 80% of the fund. And when we're seeing the types of valuations in Canada today, Annabelle, that we hadn't seen, in the past few decades, we think this represents a tremendous opportunity because number one, we're getting superior levels of income. Our companies are generating cash flow like we haven't seen in the past 10 years because they've really brought down their amount of debt. They've got very mature businesses with really strong moats. So a lot of that cash flow is now being prioritized to return to shareholders in the form of growing dividends. So all these businesses have a history of growing their dividends. Number two, their valuations. When we look at our Canadian market right now and the companies that we own in Middlefield Canadian Income, they're trading today at about 15 times earnings. The S&P 500 trades at about 21 times earnings. And let's just exclude the Mag 7. That's still at about 17 or 18 times earnings. So we're still at a 2 to 3 turn discount to what I would think is our peer group in terms of where these Canadian businesses are most comparable. We're in that mid-cap part of the market, about $40 billion average market cap in our portfolio, and in companies that we think are really well positioned, not only because they're solid fundamentally, but also because we now are firmly in this period where rates are now coming down. And I think that's causing investors who may not be focused on growth, but focused on income and getting an income solution that they were getting from their bank account or from their term deposits are now looking to equity income securities because number one, they pay growing levels of income. Number two, they're attractively valued.
Well, that makes a lot of sense. With rates coming down, investors going to start looking for equity income. Absolutely, Dean. I'm right with you on that. Now, we've had Magnificent Seven has had an incredible run, but it does look like the rally is beginning to broaden out. And I'm interested to get your view on that and its impact on your portfolio. I'm going to start with Sven.
Yeah, last year it all has been around the Magnificent Seven. I mean, you had an average return of around 80%. If I round up a little bit, the rest of the market, as just mentioned, up percent, only 8% up. But that's changing already. Look at the beginning of the year in the large cap space, you have financials, industrials, healthcare, materials. All these companies are coming back. And the same is true actually in the small cap space. All the small cap indices, value, core growth are in positive territory, double digits since the beginning of the year, especially strong in the quarter to date period. And I think this is only continuing. The expectation for small cap earnings is twice as strong in our view than for large cap earnings going into next year already. So we see investors moving away from this concentration in the market. Those top 10 stocks in the S&P make up 35% of the index. That's a lot of concentration in two handful of names. So investors are moving down, investors looking for more opportunities in the small cap space, and they are also in the small cap space broadening out. So the sectors that I mentioned, industrials, materials, we also like them, especially when we look at the small cap market. So I do think this broadening out is continuing, and especially when we think about AI, this is only going into impact all of the other sectors that have not benefited from this trend that much yet.
Excellent. Well, this broaden out is really definitely going to affect those small cap sectors that you've just been talking about. And Dean, let's talk about the broadening it out, because again, that, for your sort of equity income type companies that you're investing in, that might be very helpful too.
There's no doubt this broadening is underway, and it started in and around June, July of this year, and it's continued since. And again, assuming central bankers continue to reduce rates over the next 6 to 9 months, I think that becomes a catalyst for further broadening. And when you think about the sectors that we think are best positioned to benefit from that, we think the REITs, which is an overweight position in our portfolio, and particularly we're focused on Canadian REITs, putting office aside, they're basically dealing with a lack of supply because of higher construction costs and more recently higher interest costs and continued growth in demand. And that's a very, very positive combination of factors for rents continuing to grow. And the REIT sector, for example, in our portfolio is up by about 15% since mid to late June this year. So the re-rating is occurring, and they're still trading at a significant discount to what we think these businesses are worth. The other part that I think is benefiting from this broadening is the energy and energy infrastructure area. On energy infrastructure, we've got pipeline businesses that are very predictable in terms of their revenue streams and cash flows. And again, they're viewed as being income proxies and interest rate proxies. So as a result, they're benefiting from this reduction in rates. And then you've got growth in production, and some of our energy producers now, whether it's oil or natural gas, we think are benefiting from the fact that the world is coming to realize it can't just rely on wind and solar over time. That will become an increasing share of that energy pie, but you need baseload power, and that's from natural gas in particular, especially as we continue to build out these data centers. So we think those areas are doing very well and still have significant runway.
Absolutely, that broadening out really beneficial those, and obviously things like REITs very interest rate sensitive. Now, Gary, obviously you have benefited from the Magnificent Seven's great success, but I'd be interested to get your view on the future of those, and also whether this broadening out is going to impact on your portfolio.
Yeah, I actually don't find these broad brush terms like Magnificent Seven that helpful when thinking about where things are likely to go, because what you have underneath that classification is a lot of quite different companies, and we're still very positive on some, and we're less positive on others. And so, two that I would highlight that we're still very enthusiastic about at this juncture are Amazon and Meta. But we haven't historically owned the likes of Apple and Microsoft in the portfolio. We feel that the valuations of those two companies look quite full relative to the scale of the companies and the future opportunities. Whereas for Amazon and Meta, we think there's a lot more growth runway there and a more reasonable starting point with regards to valuations. I would agree with the broader point that that we own a number of mid cap growth stocks in the portfolio where it seems like fundamentally we've been tracking ahead of quite a long time. And we saw that last year with the our investment trust, where we had, I think it was 38% weighted average revenue growth in the portfolio in the year where the NAV rose in the mid-teens. And so the companies are executing well. A lot of these mid-cap companies haven't been rewarded by the market. I think part of that was the expectations around interest rate cuts being pushed out. But our sense is there's quite a lot of potential energy in these companies now, with valuations having come down, but fundamentals remaining strong.
Absolutely. Well, that's exciting. Those mid-cap growth companies was going to see them benefit, I'm sure. Now, how about the risks? Dean, where do you perceive the risks for investors at the moment?
So let's talk a little bit about the upcoming U.S. election, because some people view that as being a risk depending on which area of the market you're focused. In our view, unless you get a sweep of Republicans through the White House and Congress, the Democrats through the White House and Congress, I think this is going to be a very manageable situation, because at the end of the day, some of their policy measures are quite extreme, and they're only going to be passed if, in fact, they actually control Congress in addition to controlling the White House. Having said all that, even if you do get a sweep, I think the types of businesses we own in our portfolio are actually going to be, very well positioned, because they're mature businesses. They're generating high levels of cash flow. Those dividends are going to be unimpeded. Our financial sector, for example, we haven't cut dividends in a Canadian bank since the Second World War. We managed through the global financial crisis in 2008, 2009, and then in the pandemic, where you saw banks cutting and suspending dividends right across the world. So I think that's a good example of the durability of the businesses that we own. The broader risks really are this potential hard landing. Our house view is that we think central bankers are getting out in front of this slowing economy and reducing rates in order to cushion the blow, specifically on the unemployment side, because it does look like inflation's come under control. And assuming that happens, I think we avoid this hard landing. But in the event that you do get that kind of tail risk occur, then I think that becomes a larger problem for the broader markets.
Thanks very much, Dean. How about you, Gary? Are you concerned about the hard landing in the US? What do you think are the biggest risks?
Well, I mean, I think, I would think about this from a sort of longer term standpoint. I think trying to predict what happens with the election, etc., is not something that we spend a lot of time on. It's not because we don't think that it's important at the margin. It's just you've got to be right about who it's going to be, and then you've got to be right about what the policies are going to be, and then you've got to be right about how the market will react to that. And we saw how that played out, almost 8 years ago with Trump. So it's just a very difficult thing to do. And so what we're trying to think about is, where might companies be over a 5 to 10 year horizon? And that time horizon sort of tends to extend beyond the average sort of political cycle. And we're looking to back companies that are resilient enough and adaptable enough to navigate and execute on the growth opportunities, regardless of who's in the White House. I would say, from a long-term standpoint, biggest risk to investors, other than trying to time the market, which is something that I think is very difficult to do and can often cause investors to have much worse outcomes than simply buying and holding, potentially on the cusp of quite a major change in the economy. And I think they're on the other side of this, that we're going to realize a lot of companies that looked safe going into it weren't actually safe. As we saw with the internet, I think a similar pattern is going to play out with AI. So I think being invested in the types of companies that have the cultures and the vision to actually navigate this upcoming technology shift, I think that's the most important things investors ought to be.
Right. It's really a technology revolution yet again, isn't it? Sven, where do you see the biggest risks?
Well, I think if we think about risk, one that always has to be mentioned is geopolitical. There have been, over the last few years, quite a few geopolitical risks. Unfortunately, it's very difficult for us to position ourselves for that. As an asset manager, we can own companies that might not be doing business in that region, but in such a globalized world, it's almost impossible. And then also the management teams that we invest in, they can't do that much about geopolitical risk. So it's all about bringing it back to the fundamental bottom up, trying to avoid it as much as possible. But again, it's not really possible. Now, the only good thing is for small caps, 80% of their revenues are generated domestically inside of the United States. So this is something where we have a focus on. And in this environment where we have a lot of geopolitical risk going on in the world, I think this is one area that investors should maybe be looking at a bit more. The other risk are recession. But keep in mind, in every given year, there's a recession risk of around 15 to 20% in the US. So this year is no different. In no way do we expect a recession for the next 12 months. It's not the base case, but there are some worries in the market, as we've seen in the media over the last couple of years. I would put a very low probability on that. The bigger probability is inflation and Fed. We've seen how that has changed already this year, how everyone in the market has been focusing on that. And we do see inflation coming down, but in some parts of the country, it's still pretty high. So if the Fed continues with their cycle that they go through in terms of interest rates right now, we would expect this to continue if inflation falls further. But if we end up in an environment going into next year where inflation is higher, maybe the Fed doesn't have to cut as much. So that could then spook the markets as well. I leave the politics side out of it because I think it was answered already, but obviously this is something that we're monitoring as well.
Excellent. So obviously we talked about some of the risks, the potential slowdown, inflation. Clearly we've got an election and it's very hard to read an election. I'd just like to find your view. What is your long-term view of the US and how is that guiding you in terms of managing your portfolio? And I'd like to ask Gary that question.
My long-term view of the US is an optimistic one. I think there is no other country in the world that comes even close to the US in terms of its ability to produce exceptional growth companies. It has all the ingredients that you want for that endeavor. World-class academic institutions, a broad, deep venture capital ecosystem. It's a magnet for talent for individuals from all over the world. It's still the place to be if you want to build a phenomenal company. And so I remain optimistic on the long-term potential for the US. I think there's no other country that even comes close. And I think that play out over the last 5 years in terms of diverging outcomes for the US economy versus some of the other advanced economies around the world.
Interesting. Land of the free and land of opportunity. Sven, what's your view? What's your philosophy on this?
Yeah, I would agree with that. I mean, from a long-term perspective, the US is still front and center. I mean, we've seen what changed over the last 2 years now. 70% of the global equity markets are in the US, especially when we look at technology, that number gets even bigger. So they play a huge role. But there's also the earnings power in the US. We do expect earnings growth for the large cap market S&P 500 of around 13% this year. For the small cap market is even higher than that going into next year. So no matter what part of the market we look at, we think the US is still front and center. We see this from clients, we see this in demand, we see this in inflow. So yes, the US election might be something that increases volatility, but if you bring it back to the fundamental bottom up, companies in the US are really, really strong. More so in the large cap space than in the small cap space, but I think this is exactly why this offers opportunities going forward.
Excellent. Opportunities going forward. That sounds good. Dean, what's your view on the long-term opportunities in the US? What's your view?
It's hard to argue with the ability for the US to continue to innovate and drive growth. And you just look at what's happened in the past 12 months where major economies and developed economies around the world are suffering, and we're seeing, what's happening in China with this economic slowdown while the US continues to chug along. And I think Canada is fortunately, riding on the coattails there, because about 80% of our exports go into the US market. About 17 or 18% of US exports come into Canada. We're their largest export market. So at the end of the day, I think Canada is well positioned because I do believe in the long-term power of the US economy, because I do believe it has that unique set of ingredients that continues to allow it to grow regardless of the political situation, which you go through this over the last 50, 60, 70, hundreds of years. The US has always got challenges politically and domestically, but they find ways to overcome them because the other areas of their economy continue to drive innovation and growth. And I think at the end of the day, that's really going to drive greater productivity and a better standard of living, which unfortunately in Canada, we benefit from as well.
Yeah, I think the UK could learn a few lessons from the US in terms of growth and productivity for sure. I'd like to thank our managers very much for joining us today. It's been really good to hear their views. I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching today.